Hello and welcome to our latest Insider interview. Today in the studio, I'm joined by Stephen Yu, who is fund manager of the Blue Whale Growth Fund. Stephen, great to have you back in the studio today.
My pleasure.
So Stephen, in terms of performance, the fund has outperformed the average global fund over 1, 3 and 5 years, and indeed since the fund launched. However, over 5 years, if you compare your performance with a global tracker fund, it's pretty much neck and neck. When I ran the data, I saw the returns were around 75% for both Blue Whale Growth and for a comparable global index fund. Why have returns been so close over that time period? Why have you not outperformed?
Yeah, I think this is one of those issue with how you measure outperformance or underperformance. And of course, I think everyone who followed our journey would have seen that we did badly or poorly in 2022. We lost money and underperformed. But what is really important, I think, when people assess performance is you need to look at a calendar year basis, which then we did very well back in 2023, 2024, and also this year. And of course, then if you look at a 5-year rolling number, it's still very much including the 2022 or maybe a bit of 2021 numbers in that sort of assessment. So anyone who invested 5 years ago, I agree with you that probably have not done as well relative to some other peers or maybe alternative. But if you invested into the last 3 years, I mean, you have done very well. So I think it's one of those things is how you measure the performance. Of course, if you invested day one since we launched 8 years ago, that you have done very well too.
And as you've mentioned, the fund has outperformed a global tracker fund since launch, which was September 2017. Could you explain the key performance drivers? What sets this fund apart from simply owning the index?
I think there are a few things. I mean, obviously, in terms of the competitive landscape, I mean, performance versus the passive trackers, I think has been very intense. I think most of the active managers have underperformed the passive trackers over the last many years. I think what's really important is you need to do a lot more work on your companies than usual, just because the macro environment is very challenging. I think what we did well over the last 8 years was that we managed to take a forward-looking view across two very different regimes. One was our exposure to digital transformations before the pandemic and during the pandemic. That would encompass e-commerce, software, cloud, digital advertising, digital payments, etc. We did very well over that period. Of course, 2022 was a bit of a reset. Then we pivoted in terms of looking for new opportunities, exposure. And since then, of course, then we ended up exiting most names that we do not own anymore. And then we got ourselves into artificial intelligence, European defense, and also some other names that we ended up having in the fund over the last few years. So I think the point that I'm trying to make here is the world continue to evolve, and of course opportunities or whether a company could outperform or not outperform would also evolve accordingly. And as active managers, I think we do have the luxury to be active, that we can change our view, we can assess the situation. We talked about Trump before, that we can assess how Trump is going to impact certain sectors or company, and you can avoid them or you can take advantage of certain opportunities. And I think the journey would continue as we speak, and you just need to stay very much on top of the developments and probably hopefully concluding on the right side of history.
In the first part of our video interview, you explained why you now only own one of the so-called Magnificent Seven stocks. So what do you think will be the key sectors or types of companies that will be the winners in the coming years?
So in terms of the positioning on the fund today, that I would say the diversity of opportunities are quite a lot there in terms of different exposures and to end markets. I mean, we talk about artificial intelligence, we talk about European defense. Equally, we have silicon sovereignty, which is about building more foundries outside of Taiwan or de-risking away from Taiwan into the US or into Europe region. We have like smoke-free products, Pioneer, Philip Morris, that's done very well. I mean, you would think Philip Morris is such a boring company, but then it has done over like 35% last year and also this year. And I think this year's return is very much in line along the same spectrum as NVIDIA, which is about 40%. And at the same time, I think luxury brands, biologics, equipment companies. And I think there are many others. But I think the challenge, though, is you just need to be certain that your companies or your exposure are not going to be impacted negatively by the macro environment, which includes Trump's tariff or policies and also where the world is heading. And I think one thing that I would say today versus how we started 8 years ago is the number of opportunities that we can deem as outperformers, means stocks that can outperform the market, is a lot more limited today than 8 years ago. I think the period of time that there's so many more winners than losers that active managers can pick has completely reversed since 2022. So I think today there are many more losers or underperformers than outperformers. So hence I think you need to dig deeper in terms of understanding the business and trying to find the outperformance.
Could you put a figure on it? What's your investable universe today and how would that compare with 8 years ago?
So I would say that in terms of the investable universe, it's still about 100 companies out of about 1,300 companies within the MSCI World Index. But of course, that 100 companies have changed quite significantly. So I think many companies that we just talk about the Magnificent Six, which we used to, some of them used to be in the fund. I mean, we had many of them in our top 10, like Alphabet, Meta, Amazon, in our top, and Microsoft in our top 10 8 years ago. We no longer own these companies. And of course, they are the biggest company in the world. So something have changed. Okay, would we be interested at some point? I think maybe, but it depends on how the AI journey is going to go, right? If they prove themselves to be a true winner, which at the moment is very, very unclear. Spending more money means you would have a chance to raise in this AI journey, but doesn't make you a winner. So I think there's a lot of question marks about the company that we used to own that we no longer have today in the fund. So I would still say there's about 100, but then it's very difficult to get conviction just because there's still many things going on. We talk about luxury brands. I mean, we do like them, but then would you want to have a very large exposure to luxury brands today? I would say the answer is probably no. But I think they do value the position in the fund, but it's just how much exposure then is very much subject to the macro environment.
In terms of your country exposure, I wanted to ask you about the UK market. I know it's a market that you don't have much exposure to, but could you explain what you do invest in? And have you been looking at the market a bit more closely, given there's no shortage of commentators pointing out how cheap the UK market currently is?
So in the UK, we have two companies. One is LSEG, and then the other one is Burberry, which obviously Burberry is very much of a recovery story since a new management team have come on board, and at the same time they're trying to go back to the roots of Britishness rather than a fashion-led house. I think LSEG, London Stock Exchange Group, as an investment has been quite disappointing this year, just because the company is fine. I mean, we still believe that there's probably a bit of an AI narrative, how they are able to automate certain functions for their customers, for the workspace product, terminal product they do. But then in terms of the valuation, probably was a bit rich, I think, at the beginning of the year, just because it's a very high quality business, very resilient. And so I think this year is actually not done well. So we continue to look for companies in the UK at the same time in the US. But I think the challenges are that if you want to find a true global leader that are probably being exposed to the right thing is a lot more difficult in the UK or European market. But selectively, yeah, you can find we managed to find a couple.
I also wanted to ask you about the fund's exposure to the Asia Pacific region. So some global funds only invest in developed markets. However, that's not the case for the fund you manage. You have around 14% in the Asia Pacific. So what does this area of the portfolio add?
So at the moment, the Asian names exposure that we have would include TSMC, which is a Taiwanese company, alongside Hynix, which is a South Korean memory company. So that only two companies in the fund that we have in Asia. We used to have Nintendo, we no longer have today. I think what we are seeing, though, I think is a direction of travel that we we would want to do a lot more work in terms of opportunities in Asia. I mean, obviously, we are allowed to invest in Asia. This is a global mandate. We want to invest into the best opportunities, and I think where we are heading, as most of our audience might agree, is that there's going to be a much more of a multipolar world in a way that's no longer being dominated by American companies. I think where we are sitting in the UK or Europe, I think we become a lot more cautious about whether US will remain our true best friend forever, and Trump have changed that a little bit. And even though, yes, okay, maybe Chinese companies or maybe Asian companies are not as friendly, I mean, on a historical basis, but I think things could be changing as well, and hence I think we would expect there's going to be some global leaders coming out from Asia. So I think that's a journey that we want to explore in the next couple of years.
You've mentioned the US, which I next wanted to turn my attention to. I firstly wanted to ask what your thoughts are on some commentators calling the potential end of US exceptionalism.
I think that's true. I think in terms of the dominance of American companies globally, I think that is probably peak on the back of Trump being elected or trying to change quite a few things globally. But I think the issue from an investor's perspective is in terms of the moat, how some of these American global businesses have built up over time, that's not easily replaceable or disrupted. If you think about MasterCard and Visa, which at the moment we own Visa in the fund, is duopoly globally outside of China. And if you think, okay, at some point that might be a third leader coming from somewhere, it's very difficult to penetrate, to have as much penetration as MasterCard and Visa globally. And even though you think about like Microsoft, I mean, we all ended up being probably quite locked into the ecosystem. Is like, how do you actually get out from the Microsoft ecosystem, or maybe the Alphabet or the Meta ecosystem, or and where we are talking about today would be the NVIDIA GPU compute ecosystem. So I think on a very selective basis, you can still expect there's more. Some of these American companies can still dominate quite a lot. But of course, then when you look at other side of the fence, let's say maybe autos, like EV cars, I mean, the Chinese company are trying to dominate a lot more outside of China now, mostly in Europe. And at the same time, I think we would expect there's other things that are going to come out from Asia that could probably compete head to head with the US, but maybe it's not as clear cut as that is the end of the US companies, and then you now want to like move away from the US. I think you want to do it very selectively.
Another key feature for the US market so far in 2025 has been the weakness in the US dollar. What are your thoughts on the weakness in the US dollar, and could this be a potential precursor for lower stock market returns in the US in the coming years?
So it depends on where you're positioned, right? If you're position, like let's say beginning of this year from a sterling investor perspective, then you probably have gone a lower return just because sterling is strengthened about 8-9% versus the US dollar. But if you're American investor invested into American stock market, you probably have done quite well. I mean, you have gone up, the S&P has gone up about 15%, which is very similar to the FTSE 100 all-share index this year. So from an American investor's perspective, they are 15% richer than this time last year. So I think the interesting narrative going from here is obviously dollar has weakened this year, but then it's about how much more dollar is going to continue to weaken. I think the question for me though is when you invest into some of these American businesses, which I mentioned about Mastercard and Visa, 50% of their earnings are coming from overseas. So they're actually making more money on the back of a dollar weakening just because they managed to repatriate the profits back from overseas to redominate into US dollar profit. And at the same time, just very similar to what I mentioned about the dominance of American companies, equally for US dollar is very much well entrenched, even though, okay, China is trying to change that, maybe India is trying to change that, but it's very difficult to do that overnight. And when we look at our own finances, let's say maybe sterling have strengthened, I'm not entirely convinced that whether I want to be holding my asset in sterling terms running into the budget in a month's time, or even maybe euro, like we have seen what's happening in France. So then there's still a lot of things going out there that obviously that's not what the investor base are focusing on early this year, just because I think there's some changes of relocation of capital. But then structurally, I think you go back to the fundamentals, and US economy is still very much robust. When you look at the health of American consumers, they are still very wealthy, I would say, on a relative basis than the rest of the world.
And we always end by asking our skin in the game question. However, I know that you do indeed have plenty of skin in the game, as I've asked you the question before. So I instead would like to ask, when was the last time you personally invested in the Blue Whale Growth Fund?
So as you know, that I only invest into the Blue Whale Growth Fund since the beginning. At the same time, we have talked about this before, that from the partnership perspective, Blue Whale Capital, which is the company, that we do invest into the fund every year. So the last time we have done that would be the beginning of this year. We took advantage of the DeepSeek moment, which then we end up investing more money into the fund, which some of the money would be my profits.
Stephen, thank you for your time today.
Thank you.
So that's it for our latest Insider interview. Hope you've enjoyed it. We'd love to hear from you, and you can comment. And for more videos in our series, do hit the subscribe button. And if you enjoyed it, hit the like button. And hopefully, I'll see you again next time.